Piramal Pharma was born from the demerger of a larger listed entity, Piramal Enterprises, and was separately listed in October of 2022. After its listing, it did see quite a volatile phase, which was really a reflection of the earnings, such as the challenges in terms of margins, as well as the balance sheet. But in the past year odd, we've seen the stock rally around 120% from its 52-week low. This has been a reflection of its improved earnings, as well as its debt figures and a successful rights issue. So what does business look like going forward? I have with me Nandini Piramal of Piramal Pharma today. Nandini Piramal, thank you very much for taking the time out and talking to CNBC-TV18. I wanted to start by asking you about your journey since listing. It's been a volatile listing, or there was a phase of volatility post-listing. Things have settled down, the stock prices actually turned around quite a bit. Can you just reflect back onto the journey of the past year and a half?
So obviously we knew when we were listing that we were not part of the index funds anymore. And the index funds had to exit the moment we listed. And so that led to a phase of volatility as, you know, index funds were listing, domestic funds didn't know us. And so we had to educate the market. So I think we've spent the last year actually doing a turnaround both in the underlying business. We did a rights issue, which actually reduced debt. And we then focused on educating investors and kind of saying this is our business, because we're a little bit of a different business to most pharmaceutical companies. Because if you think about it, our major business is contract manufacturing, where we make drugs for other people. Hospital generics, which is a little different again than branded generics. And then we have a over-the-counter drugs portfolio. So it's a little bit different to others, and so we had to actually educate people and say, look, this is how we work, this is kind of how the business is. We've got 17 manufacturing sites that are spread across the UK, the US, Canada, as well as India. So we're just a little bit of a difference.
Okay, well, I'm going to get to, discussing the verticals in just a bit, but you raised around 1,050 crores via rights issue successfully. How much of that was used to pay off debt?
The majority of it was used to pay off debt. We actually reduced our debt to equity to about 3.1 at the last quarter. And the plan is that we want to keep it, below 3 for this end of this financial year. And then beyond that, we'll see.
So what is the gross debt on books right now?
It's about 4,000 crores.
Okay, so what would be an ideal figure?
I think we'd like to, as I said, right now the aim is to get to below 3. And next year we'll talk more about it.
Okay, all right. In terms of the debt reduction, do you think that having this kind of debt on your books is probably going to constrain you in terms of growth?
I think we've done a fair amount of debt reduction. I think we're reasonably comfortable with keeping it below 3. And I think as we think the business improves, you'll see organic growth in revenue and EBITDA will mean that the ratios are actually quite comfortable.
And below 3 would be a target by when?
We're aiming to be between the end of this financial year.
All right, now let's get to the business and the verticals. The CDMO business is majority of a business, over 50% in terms of sales. And yes, it is a difficult model to understand because you do cater to multiple models of the pharmaceutical space. Just tell us, how exactly is business doing within that space currently?
So I think business is doing very well. We've recovered from actually a very tough year. And we've seen very good order inflows, especially in our commercial on-patent book. So as a business, we were moving from a transition from doing generic APIs and generic formulations to doing more on-patent work. And the other transition that we were making, we were doing a lot more integrated project. So what we define as integrated is that it'll cover more than 2 sites. So for example, it could be that you would make something in India and then finish it in the UK or the US. So for example, we announced that we got our first ADC to fill finish project, which includes a MAB. So we'll make the MAB at our associate company, Yapan Bio. Then, 3-6 months later, once the MAB is made, it'll go to Grangemouth, where, we'll do the ADC and the conjugation. And then post that, it'll go to our Lexington facility. So that's in a way a very ideal integrated project. but it could also mean that we make the API at a plant in Digwal and we make the formulation at formulations plant in Pithampur.
Okay.
So there are different modalities of that.
Well, the CDMO business, like you mentioned, it has seen challenges, and one of the bigger challenges has been the biotech funding, which has seen a slowdown in the US. How has business been impacted?
So if you think about it, in the last 3 years, there's been the lowest funding of biotechs. There's been a challenge because as interest rates have risen, people have decided that they would rather invest in other things rather than the biotechs, which by definition are risky. I think last year saw the lowest number of IPOs in the US for biotechs, as well as probably the highest number of bankruptcies. Now that has affected our development order book. That's the things that start out in phase 1 and phase 2, and you actually do the work in that. But the benefit that we've had is that some of the work that we've done with biotechs previously that are past the proof of concept stage and are about to go to commercial, that commercial on patent book has actually proven to give us good orders. So it is a mixed bag.
Okay, so your CDMO business grew around 12 to 13% in the previous quarter. What are you probably targeting?
So I think for the second half, I think we're saying mid-teens growth and a significant improvement in EBITDA.
Okay, and when it comes to order inflow, will it probably be better in FY25 versus FY24, or do you see these challenges continue?
I think in FY25, I think it will depend on what happens to interest rates in the future, as well as what happens in the wider biotech funding framework.
And what is your sense on the wider biotech funding?
The most optimistic people say September, other people say January, so I think we're going to plan and see how it happens.
Okay, all right. The other segment is obviously your inhalation products. I think you're one of the third or the fourth largest player globally. How's that piece doing, considering that there's lesser amount of price pressure and competition?
So the business has been doing quite well. We have significant market share in the US, as well as the UK, and Italy, which is where we have direct distribution. There is headroom to grow in the rest of the world. And until last year, I would say we were capacity constrained. We had a plant in Bethlehem that, we had to do a lot of debottlenecking and, some modest CapEx improvements to improve the capacity. And so we did that last year. And so now the benefit is we're no longer supply constrained. And we're looking to therefore increase shares in parts of the world where we don't have significant market share. So I think I'm actually quite confident about the business. It is a generics business, so there'll always be price pressure. But because we're vertically integrated, we I think control a lot of the supply chain.
What is the pipeline?
So we're adding generic injectables to that because you've built a distribution structure to serve the inhalation anesthetic. So we actually just launched a bunch of generic injectables. One of them is a zinc sulfate generic injectable. So we're adding those into the hospital pipeline.
Okay, so when you mean generic injectables, are you focused on regulated markets such as the US?
We would be focused on regulated markets such as the US and Europe as well. So those would be the biggest.
What is the pipeline looking like? How much can we expect in terms of launches?
I think we have about 25 generic injectables currently in the pipeline at various stages of development, and I think we'll continue to add some more.
Okay. All right. The other piece is obviously your OTC segment back home. You have a couple of power brands, and I think that's around 40% of your sales. You're touching around 1,000 crores in terms of revenue within that segment. How is that segment performing? Is it largely being only driven by your power brands?
I think power brands is where we're spending the investment in media and advertising and focus of the sales force, as well as we're adding new products to those power brands, right? So for example, our Little's baby brand, we started out with wipes and we added diapers, we added, feeding, we added grooming, continuing to add ranges to that. So I would say that, yes, the power brands are where the most growth is because that's where the focus and the investment is. And we believe there's a lot of headroom to grow. There's the baby segment alone in India is we're a young country that people are still, getting married and having babies, and people want to do the best for their babies. So I think that's I think as a consumer products company, I think this is a segment that I'm very excited about, the Indian consumer. I think they believe in looking at new brands, and they are price sensitive. So you actually have to give consumers a value proposition of both price and quality.
But the margins of this particular segment, I think, are in mid-single digits. When are you probably increasing margins?
So I think now we are reaching a certain scale. I think the focus will switch to, paying attention to profitability as well. So whatever profit we were making, we were reinvesting into advertising, right? And as you get scale, you don't need to actually put the same percentage margin back into advertising as you do, with a smaller, because an ad campaign will cost the same no matter, what the size of the brand is. So that's a benefit. That's one of the scale benefits. I think over the next few years, we will, kind of make a transition to what we're seeing in the next 3 to 5 years, early-ish double digits profitability.
Okay.
And then as you get bigger, then that can also increase. But
okay. But this segment is also considered to be a possible lucrative segment to consider divestment in. Is that something which the company has considered, considering the kind of multiples a lot of the deals are getting within the Indian domestic space?
We still believe that we're one of the few pharma companies that has such a large OTC segment. It gives us, a very good handle on the Indian consumer. So at this point, I think we'd like to grow it more.
Okay, so divestment of one or any of the brands is off the cards. But would you look to probably acquire?
We would, but again, the valuations, as you mentioned, have been very high. And so somehow, I think, again, as a public company, investors will say that, look, what is the bottom line? What is profitability? You may not be asking the D2C players or the new consumer internet players, any of those questions, because they're not. So I think as a public company, you're valued on, PBT, PAT, that's what people look at. Profitability, right? And margins.
Yeah.
So when you when you look at those acquisitions, you're like, but when are you going to make profit? And sometimes there may not be an answer. And so maybe, we're focused on cash and
preservation at this point.
Not cash preservation, but like free cash flow.
Okay. All right, so that's the larger picture that you're probably holding off in terms of acquisitions at this point in time. You're probably going to be focusing on the balance sheet as well as the P&L.
Our focus is organic revenue growth, improving profitability through fixed cost leverage, reduction in cost and operational excellence. That's the focus for the next year.
You have been incrementally in the domestic formulation space. That's the OTC segment that we spoke about. But with your JV that you have with AbbVie on ophthalmology, and you have Yapan Bio, which is basically within the biologic space. But you're not full-fledgedly into domestic formulation, something which you sold to Abbott in 2010. So what is the plan to get back there?
Actually, nothing at the moment. The reason is the synergies are quite different. They're not there anymore, right? We don't have the field force that is used to selling to doctors. The OTC field force is a different, they're used to selling to retailers. They're just not able to sell to doctors. So we don't have that experience. And I think even in supply chain and distribution, those distributors that handle OTC products are a bit different than the ones that handle purely pharma products. So I think if you look at it, if we were to do an acquisition, we wouldn't have the synergies that any other pharma companies would have. And that puts you at a disadvantage.
Okay, so you're not looking to re-enter domestic formulations?
So at this point, we're not looking to do that.
Okay, your larger picture in terms of focus would be CDMO, your inhalation segment, and your OTC, and probably more of a foray into biologics and keeping domestic formulations away. What would your revenue share look like from these segments, say 2 years down the line?
Right now, I think that proportion-wise will probably be, it's probably 50, 35, 15, It's kind of around that.
Okay, so similar to what it is
Similar to
currently. Okay, well, just talking about the guidance a little bit on the near term, you have mentioned that the second half in terms of performance is probably going to be better than the first half. We have 1 quarter left. What's it looking like?
I mean, we're sticking to what we said earlier, that we think for the second half we should beat mid-teens growth as well as a significant improvement in EBITDA. The CDMO especially is a seasonal business. A lot of our orders come in the final quarter of the final quarter of the financial year, because for our customers, it's quite often their first quarter. So they tend to shed inventory and kind of close their books at their final quarter and then say, okay, now I want to order for the first quarter. So the final quarter for us always ends up being very heavy.
Okay. And FY25, any trends? I know you've said that you don't want to talk about guidance in specific.
Yeah, I think the thing is we're waiting to see kind of what happens to the biotech funding and how it shakes out. And then we will, and then we'll talk more about it. But I think right now, I think the focus is on closing the year. We've got, as you said, we've got 6 weeks left. That's the focus.
Okay. Well, just, digging deeper when it comes to margins, it's been a volatile amount of, margin picture since the time you listed in October 2022. And you also had margins falling all the way to, I think, around 5%. What is a sustainable level for the margins?
We think we can, in the 3 to 5 year time frame, get to about 22 to 25% on a sustainable basis.
And at least in the near term, considering that margins
So I think what we've said is that we'll see significant improvement back to, we aim to get to back to pre-2020 margins.
Okay, but in the past 2 quarters, it's been above 13%.
Yeah.
So are you sustaining above those levels?
I can't actually comment on the next, but I think, as we said, we should see significant improvements.
Okay, all right. One of the key, points when you also listed, which stood out to me, was the very little regulatory issues that you all have faced. Do you have an OAI as of now?
No.
How do you manage to maintain such a clean track record when it comes to US FDA issues?
So I think first is culture, and then there's systems and process. So I think if you actually have the culture of saying that as an organization that says quality is incredibly important, right? We are trying to make that very real to people by making patients and centricity, in a way, the critical part. So we actually get our customers to get their patients to our manufacturing plant to say, this is who you're helping. This is what you're making. Right? And I think that makes a difference, right? Because we're making pharmaceuticals, and if you're giving those pharmaceuticals to your family, you want to make sure that they're safe. You want to make sure that they're, good quality, and that they do what they say they're going to do, right? And that, I think, is critical. So one is making everybody understand this is what you're doing, and that if you don't do your job, some patient out there isn't going to cure their disease, get relief from their kind of health issues, and again, making it real. But then it's also systems and process. So for example, I think we get audited over between like 180 to 200 times a year by our customers. So if I look at my, all my sites, I have someone coming in every month, right? And that means my team, and the team is completely audit ready, right? Because you've got very different customers coming who have a different point of view. And then we kind of have to say, look, this is the Piramal point of view, and this is why we're doing something. So you have a lot of eyes on it. We do surprise corporate audits. So we actually have our team coming, and they'll knock on the door on a Monday morning and say, we're coming, right? We're here to audit you. We're not telling you anything. We're going to, so again, that's a lot of prep.
Yes, absolutely. But most Indian pharmaceutical companies have the same routine that you do when it comes to audits, but they still have issues which crop up.
I think it's,
so. What is the one?
It's culture. Culture and process and systems.
So when you say culture, what does it mean?
Again, as I said,
it's top down.
It's top down. It's about making it very clear. As I said, it's like, look, quality is what we do. that's why we're in business.
One of the key points has been that you did get that money from Carlyle, I think over around $350 million in 2020. How was that funds actually utilized?
Some of it was used to pay down debt as part of the parent company.
Okay. And what is the plan in terms of their holding? How much do they hold currently? What is the plan on exiting?
I think they all hold about 18%, and we've had no conversations about exiting so far.
They've done, would that probably be on the agenda for them?
I think that presumes so, but we've had no conversations.
Okay, all right. No conversations as of now. Well, Nandini, give us a sense in terms of where exactly we're going on a 3 to 5 year basis for Piramal Pharma, because you're almost closing in on $1 billion in terms of sales.
I think we think over the next 3 to 5 years, we should be able to do a mid-teens growth and improve margins to 22 to 25%.
All right, Nandini, it's been great talking to you. Thank you very much for joining in and speaking to CNBC TV.
Thank you, Ekta. It was a pleasure.
Thank you.